Good morning and welcome to the CG Asset Management Q4 quarterly update presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated in the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself, however the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand over to Katie Forbes, Head of Investor Relations. Good morning.
Good morning. Thank you all very much for attending today's Q4 2025 webinar. I'm joined here by our Co-CIOs, Peter Spiller and Chris Clothier, who will walk you through key trends we saw in 2025 and what our macro views are of the year ahead. Before we get to the interesting stuff, just want to quickly go over that please do not take any of this as investment advice, and the value of investments can go up and down. As a reminder, we manage 5 open-ended funds and 1 investment trust, and if you have any questions at any time, please feel free to reach out to me. Without further ado, I will hand you over to Chris and Peter to get started on the presentation.
Morning, thank you so much for joining. So I'm just going to start with just a very quick review of where we are, and then probably touch a little more on how we got there. So our asset allocation today is firmly at the more defensive end of where we would see things ordinarily. We have 25% of the portfolio, we have 32% in managed liquidity reserve, of which 25% is in cash and short-dated and nominal government bonds. The vast majority of that is in short duration hedged JGBs, where we continue to earn very material excess returns over comparable gilts. So that's a pickup of 35 basis points for about a 4.1 yield on that part of the portfolio. Our credit is at the low end of the range, and that is at 7%, and the majority of that is in index-linked corporate credit, which is investment grade. We have a high allocation to inflation-linked bonds. Duration in the UK is 5.5 years. Our US duration has changed materially over the quarter, and we'll talk you through some of our reasoning behind that, and currently stands sub 4 years. Risk assets have come down over the year, and they now comprise chiefly equities at 14%, and alternatives at 7%, and within the alternatives, the vast majority of that is made up of core infrastructure, and we now have very little exposure to renewables. As you can see, Q4 was a positive quarter across all asset classes, with the exception of our nominal government bonds, and that was a function of moves in the yen exchange rate for our relatively small unhedged Japanese yen position. So what happened over the course of the year? As you can see, the overall trend has been a reduction in risk. So we've taken about 6% out of risk assets, gone from about 31 to about 25 over the course of the year. That with roughly equal amounts coming out of the alternatives, and that was chiefly out of renewables, which we sold over the summer, and our timing there was good because they have since underperformed quite materially, and equities, where we've brought those down against ever higher valuations, which I expect Peter will talk to later on. As you can see, and then that money was moved from the risk asset portfolio into inflation-linked bonds, into managed liquidity reserve. The UK index link went from 15 to 19 over the course of the year. It actually, what went on under the bonnet was rather more dramatic. Perhaps it's such a long time ago now, we probably don't remember, that there was an extraordinary squeeze in short-dated UK index linked in January of last year. Yields went negative on the March 2026 and the 2027 maturities, and so we sold those in that quarter and bought into tips on a hedged basis. And then, but however, as the year progressed, values got better and better across the UK index-linked curve, and so we added back and then added further to take our weighting to 19%. Our TIPS holding looks sort of substantially unchanged over the year, though in reality, the path throughout the year was somewhat more dramatic than that. We sold TIPS and sold exposure to the dollar over the course of Q1. We were concerned ahead of Liberation Day, as it became known, about what the impact of that might be on the dollar, and we reduced our exposure to the dollar in that quarter by 5%. We have then added back to the dollar in Q4 of last year. In truth, our timing in that hasn't been spot on. The dollar has continued to weaken, but that reflects some of our concerns over sterling, which again, Peter may touch on later. That's probably enough on the big moves in the portfolio. Let's turn to the performance of the risk assets and the bonds. What we were really pleased with on the risk asset side, and you can see this, if you look at the performance, they held up very well in the early part of 2025. So our risk assets fell in value by about 2% peak to trough from kind of February through to the end of April. By contrast, the investment trust index fell 13% over that period. So it was nice to see that even our risk assets were behaving reasonably defensively. On the bond side of the ledger, you can see that we've actually had muted performance over the year relative to sterling ag. And I think that reflects the fact that while we trimmed dollar exposure over the course of the year, generally sterling was strong over the year. And so there was some underperformance in our bonds arising from that benchmark. Again, this all seems like really ancient history now, but we jolly nearly had a bear market in April. So the MSCI World fell peak to trough in sterling terms 18%. Our portfolio fell peak to trough 3%. So we were delivering the kind of defensive characteristics that we would have hoped for. And actually, we were particularly pleased about that in the context of the fact that we would normally expect to see in that kind of risk-off environment the dollar to see a bit of a bid, treasuries to see a bit of a bid. They didn't particularly. And so actually the fact that the portfolio held up as well as it did was reasonably pleasing. Then this just talks to the asset allocation ranges. So as you can see, there is a light blue blob for conventional bonds and cash, but it's underneath our max blob because they are the same. So we're at our max weighting in conventional bonds and cash at the moment, which reflects our view that now is not a moment to be taking material risk. Our corporate credit is almost at the lowest levels that we have seen, and that reflects the fact that credit spreads are exceptionally tight, and we see very limited value there. Our inflation-linked bonds, as you can see, are above average, and our risk assets, as I've mentioned, are at the low end of our range, reflecting our defensive stance. So if you will indulge me, I'm just going to sort of remind everybody of the context of 2025, because it was a really fascinating year. So, we started with US tariffs. And so tariffs in the US went from 2.5%, the weighted average effective tariff rate. They peaked at about 27% in April, and they've now since fallen back to about 17%. Of course, we're awaiting with bated breath how the Supreme Court will rule whether these tariffs are constitutional or not. That, I guess, in turn, will have an interesting consequence for US deficits. Then, of course, in June, we had the brief in Iran-Israel war, where Israel bombed Iranian nuclear facilities. Tragically, the Ukrainian war has rumbled on. We now have a total of 50,000 civilian casualties in Ukraine, 14,000 dead, 38,000 injured. Russia, who knows, but there are estimations of around 1 million casualties, of which about 250,000 dead. And Ukraine has indicated that they have lost the lives of, well, certainly President Zelensky has quoted a figure of over 100,000. Estimates go up to 160,000 of dead or missing in action. The other big story, I suppose, is the rejection of the kind of institutional, the global institutions that have formed the kind of the framework for geopolitics since the Second World War by Donald Trump. And that has in turn led to, I guess, a reemergence of a kind of realpolitik, the concept of spheres of influence. And in many respects, this has been led by the US, which has enacted, I guess, a renewed, more extreme Monroe doctrine. And we've obviously seen the results of that culminating this year with the capture of President Maduro of Venezuela and the extremely aggressive saber rattling with respect to Greenland. Turning to the economic front, again, this all seems like really ancient history. We had the DeepSeek AI breakthrough in January, which caused a 17% drop in NVIDIA's share price, which was the single largest fall in equity value for a stock in history, $589 billion. That has, I guess, largely been forgotten about. All those concerns turned out to be unfounded. I'm not entirely sure which of those is the correct explanation. China continues to confound in the sense that, on the one hand, it recorded its largest ever trade surplus in 2025, estimated to with an outturn of $990 billion. And yet, on the other hand, its property crisis, if not necessarily deepened, then certainly has continued with 5 consecutive years of falling new home sales. And then, of course, in the US, we saw the longest shutdown in American history at 43 days, which is estimated to have taken 1% to 2% off the annualized growth rate in the fourth quarter. And then finally, deficits as far as the eye can see, around 6.5% in the US, greater than 5% in France, greater than 4% here in the UK. This really is starting to be a problem in our view. So if you had kind of painted that picture and asked me what I would have thought would have happened to markets around the world, I probably would have plumped for a safe haven kind of trade. Perhaps you'd expect the Swiss franc and gold to do very well over the course of 2025, and sure enough, they did. But what has been interesting to us is that substantially all asset classes performed well. So here you can see the performance of some of the major equity markets, commodities, and sterling ag. All of those are denominated in sterling terms. And then finally on the right, US ag also performed well. That we've left in dollar terms. So that is certainly, I think, came as a surprise to all of us at CG. So enough of that. I'll just touch on a couple of parts of the portfolio just to kind of illustrate what we've been up to. So our emerging market holdings, which comprised 15% of our overall equity allocation, so a relatively meaningful position, performed exceptionally well over the course of 2025, delivering returns of about 30% overall. The other thing that was interesting was, frankly, the spread, and that, I guess, shows the benefits of diversification across the holdings. In aggregate, this portfolio performed very satisfactorily. The laggard was an investment trust called MMIT, Mobius Investment Trust. And if you had asked me at the beginning of the year which of our emerging market holdings was likely to perform best, I probably would have told you that it was MMIT. The rationale for that was that it was trading on a relatively wide discount and offered guaranteed liquidity in Q4. And so, that we could see our way to a very nice excess return. As it turns out, they run a highly concentrated portfolio, and that portfolio really didn't work. It's not quite as bad as it looks on the screen, because we tendered our shares, and those shares will come back to us probably over the next couple of weeks, and we would expect an uplift from the share price that you see there. Aberdeen Asian Focus Fund, the pink line in the middle, there we actually did better than that line would suggest, because our investment came in the form of converting a convertible bond, which we did in July at a discount to the then share price. So we missed out on the trough earlier in the year, and then enjoyed very substantial returns thereafter. But really the standout performer was Fidelity Emerging Markets. And that's been an interesting story, where this was a vehicle that used to be managed by a firm called Genesis. It moved over to Fidelity. We have always felt that they were going to need to tidy up the elements of the register. They have done so by putting in place a historic tender, which we have participated and enjoyed. There is a tender coming up in the future, which we would also expect to participate in. And then a key change that happened was that they bought back nearly 20% of the company from a pension fund at a substantial discount to NAV, which resulted in a 4% uplift to the underlying net asset value. Despite this very good performance, we don't think that the story is fully finished, because the result of all of this is that the board have got a highly concentrated register of major shareholders, and we think that they're going to need to take further steps to make this a more viable vehicle. So we're happy to continue to hold it for the future. Turning to the tips side of the portfolio, as I mentioned, we materially reduced duration of our tips holdings in Q4 of this year. So far, as you can see on the right, that has been was the correct decision. Now, really, what was going on here? Well, as I'm sure you know, we have two tensions in holding long duration tips. On the one hand, we've always felt that these are very good assets in protecting against recessions, in that we would expect real yields to fall in the event of a recession. On the other hand, we have concerns over the fiscal outlook in the US, and that ultimately that will lead to a crisis in the bond market, as bond investors essentially get fed up with financing ever larger deficits as far as the eye can see. And I suppose that those two concerns have been in tension with one another, but over the course of the year, our concerns over the fiscal situation have come to dominate our thinking, and so we have responded in that fashion. We're still really happy to hold index-linked bonds at shorter durations, because we continue to think that the most likely macroeconomic environment over the coming years will be a stagflationary one, and that they will continue to outperform nominal bonds, as indeed they have over the last 5 years, as indeed they have over the last 25 years. And then finally, we have been able to continue to find niche opportunities in investment trust land, I highlight this one, which is a company called Doric Nimrod Aircraft Leasing 3. I may have that name correct. Anyway, it goes by the ticker DNA3. And this is one which is maturing over the next 2 weeks, so it seemed relevant to mention it. And it's a relatively material position for something that is quite small and quite niche. We've got about 55 basis points in this. And really, what we identified here was a situation where Airbus, this owns a portfolio of Airbus A380 planes that have been leased to Emirates. We had a high degree of certainty that Emirates were going to purchase these planes, and then sure enough, over the course of our ownership, they confirmed that they would. We also had a reasonably high confidence that the market was underestimating what the overall proceeds from that would be. And then ultimately, we found ourselves in a very attractive situation in late summer last year, once the entire purchase had been agreed by Emirates, and therefore we were essentially taking Emirates credit risk for the following 5 months, which is something that we were quite comfortable with. And then latterly, in the last 2 to 3 months, those sales have completed, and therefore we were no longer on risk at all, except for perhaps unexpected liquidation expenses. So as you can see, we built into this position over time and generated high teens IRRs for a situation that we felt carried very little risk. And so that has been a nice, modest investment. Right, that is enough from me. I will hand over to Peter for the outlook. Peter.
Thank you, Chris.
So please tell me when you want me to switch from one slide to another. There it is.
So clearly one of the big movers in the last year has been gold. And a lot of that movement is attributed in press commentary to the so-called debasement trade. That the dollar will become worth very much less in buying power. But what's interesting is that the FIPS market absolutely does not reflect that view. So we've had inflation here for the last 59 months at above target. But nevertheless, break-even suggests that the market believes that inflation will be just 2% for the next 30 years. And I think that is based on an experience for most of the working lives of the people in this market earlier this century. So in the 20 years leading up from 2000 to COVID, there was phenomenal deflationary effect from China. We think for various reasons that will not persist in the future. And inflation looks as though it's settling in, not at huge levels, but perhaps 50% of life, i.e. at 3%. And one of the reasons for believing that, if we could go on to the deficits, is the extraordinary approach fiscal management in the United States, and actually to a lesser extent in the UK. So we have seen deficits this large, but they have always been in times of war. Never in peacetime has anything like this been attempted. And we've got an excitement coming up in the next few weeks, one assumes. So every Friday, occasionally it's Thursday, but every Friday, the Supreme Court announces some decisions. I'd like to get a decision on tariffs last week, but we did not. So we'll see if we do this week. But there's a 75% chance that they will, according to predicted, that uphold the view of the lower courts that tariffs are in fact illegal. And if they do turn out to be illegal, that will add another $300 billion to the already extraordinary levels of deficit. So Keynes, well, this is not Keynesian economics. It's much more like modern monetary theory. And on the right, we have the consequences of that for debt-GDP ratios. And I don't believe anyone thinks those are sustainable. But there are plenty of people who think that the crisis will not happen in the very short term, and therefore they can ignore it. But the evidence in the bond market is that actually it's becoming much more difficult to sell very long bonds, 30-year bonds, or even beyond that in the UK. And so the proportion that is being sold in shorter duration is rising. But for the moment, you can still sell 10-year bonds in both markets quite happily. And the problem, I think, for equity markets comes when 10-year bonds become more difficult to sell. So we think that will happen. We don't know when. It could be quite a long time. And in a way, the UK is more exposed to this than the US, because the US, for all its faults, is still the reserve currency of the world. And the UK depends on the kindness of strangers to buy its debt. The final point to be made about this is that if indeed inflation did turn out to be low in both countries, then the debt becomes an ever greater problem, because nominal GDP will not be rising fast enough to get that ratio to improve. And in fact, it is likely to continue to deteriorate. And that is obviously not a sustainable situation. So if we turn to equities,
Sorry, we're turning.
right. With that. So we've got an extraordinary situation here, where if you recall back in the late teens, valuations were pretty high, but the justification was that there was no alternative. TINA, as it used to be known then. And now valuations are even higher, that we'll get to looking at in a minute. But there sure is an alternative, and the alternative is to buy, in our view, index-linked bonds, which, for far less risk, give the same return. We might move on to look at the returns on the S&P in a different way. So it's not a surprise that the price you pay for stocks determines the returns that you make from them. And if we look at CAPE, so this is the cyclically adjusted price earnings ratio, you can see that we are a really extreme valuation. So we put the buckets here by deciles because there aren't that many examples. And for this decile, for the bottom 10% or the top 10%, whichever way you look at it, the 10-year returns have been about 0.5% real. But it's worse than that, because we are actually in the bottom 1%. So there isn't much history to go on there. The only example has produced a negative result. But it wouldn't be inconsistent with the general trend of this chart to see a negative result here too over the next 10 years. However, excuse me. what is happening in the short term is that retail flows are driving prices and often using considerable leverage to do so. And we have a strange situation where fund managers are actually following retail flows as we analyze it, because professional risk doesn't lie in losing money. Professional risk lies in being different from your peers. And the peers are fully invested. So cash, according to a Bank of America survey, has never been so low in investment funds. So there's an element of speculation there. Retail trading is obviously very difficult to anticipate, but certainly at the moment, speculative flows are strong. And if we look at the forward PE, just to look at it a different way, we get a very similar result, rather surprisingly, really, because earnings are at an all-time high against the GDP, as a percentage of GDP. And therefore, you would expect PEs to be relatively modest because of mean reversion. Far from it, you can see that there are levels here where, again, the expected 10-year return is roughly zero in nominal terms. So that will be a very significant loss in real terms. So why are we there? Well, every strategist, the Bloomberg survey, 21 strategists at the turn of the year, all of them were bulls. All of them thought, and actually very clustered around 10% return for this year. The reason for that is very clear. The earnings are expected to grow by about 13–14%. Interest rates are expected to fall because of political pressure from Trump, and we've seen that play move on a bit with the threats to Powell that have emerged in the last couple of days. And so the standard consensus expectation is for roughly 3 further cuts. So what's not to like? And what's not to like is those valuations. And it's just worth recalling how big the falls are when the climate changes. So in 2000, the market fell by 49%. The great financial crisis by 57%. I feel for us, it's really important to avoid those downturns. Financial conditions have never been easier. Excuse me, they have been easier, but only in the everything bubble 15 years ago. But they are very, very easy. So it's not surprising that things have been bred up to extraordinary levels. But I think there's a very big difference between the response to that professional fund managers have to make, which is they have to participate because they cannot afford to see the market rise without their participation. And individuals, I think very few individuals can face with equanimity the prospect of losses of the kind I've just mentioned. And therefore, they, we believe, should have a much more defensive portfolio. We run our funds on the basis that they are absolutely for individuals or for long-term institutions who care about maximizing their returns over the long term, and can look through short-term underperformance. So that's why we are where we are, and I'll hand back to Chris to summarise to Katie.
Great. I think with that we can move on to Q&A. We have received a lot of questions already, but please keep them coming through. And if we can't get round to answering your question, we'll send a written follow-up afterwards. Chris, you have been eyeing the questions as well, but I think, yes, I think it's sensible to start with the HICL questions. So can you provide an update on HICL? Have you sold your position, and what are your current views?
The short answer is no, we haven't sold. So we did, when they announced their, in our view, very ill-judged merger with Trig. On the day that they announced it, we did sell some shares as essentially for risk mitigation purposes. As the process went ahead and we increasingly gained confidence that we would be able to prevent the merger from happening, that then meant that we felt we didn't need to sell anymore. We remain very happy with it as an investment, and indeed, if anything, we're probably happier with it today than we were, because I think that the board are now incredibly unlikely to put forward any M&A activity that is likely to be not friendly to shareholders. So that's encouraging. I think the other thing which we felt, as it happens, they announced their interim results about 4 days after they announced their proposed merger with Trig. And if you wanted to read a document that set out very clearly why they should not have merged with Trig, it was that set of interim results, because they read very, very well to us. So we're really happy with the underlying portfolio. We continue to believe that it will offer total nominal returns of the order of 9 to 10%. So yeah, remains a significant part of the portfolio, and we are happy with it.
Fantastic. Thank you very much. The first question we received is, why has the company had a holding in North Atlantic smaller companies for such a long time? Is the manager happy with the share price performance of North Atlantic smaller companies?
Right. So that's for me, because I'm responsible for well, I've held it for a very, very long time. So the first thing to say is actually it's been an extraordinarily satisfactory investment for us over the period we have held it, which has been now probably 30 years. It's been a very long time, a long-standing investment. And I well recall that in the late teens, North Atlantic was second in the long-term performance of all investment trusts, behind only Capital Gearing Trust at that stage. But it is certainly correct that the performance has been very lackluster in recent years. So in response to that, we obviously looked at whether anything's changed in the investment process. We do not believe that it has. The manager, Chris Mills, remains an extraordinarily vigorous and active manager. He's been operating in a world of his universe is largely in smaller companies, which obviously has been a very unhelpful place to be. But the shares remain extraordinary value. So they have a discount in the low to mid-30s here. They have put in their report and accounts each year a statement that when Chris Mills retires, so he's younger than me and very vigorous, and I hope he will be for some time, but it is not that much younger than me. And so he will retire at some stage. And when he does, there will be no further investment until the discount is at very low levels, I think they say, so something less than 5%. All the proceeds of every sale will go into buying back stock. So I find that very reassuring. And as I say, I have every hope and confidence that the relative performance will pick up going forward.
Fantastic, thank you. The next question is, 3% in property appears at first glance to be a little low, especially with many REITs still trading on large discounts. What are your thoughts here?
Yeah, as well, Peter.
Right. Well, I mean, the interesting thing is what is the NAV? We think that property, speaking generally, underestimates the impact of depreciation. So the office which I first worked at in the city was quite new then, but it's been redeveloped twice since. So clearly the return should be adjusted for the fact that you got to write off the cost of building it twice over that period. As a broad statement, we think that on the whole, some yields in the property market still haven't really caught up with the change in yields over the last 5 years. And then there's been some specific problems. So Ranger, for instance, which is a well-run company and with a balance sheet that's possibly a little stretched at the moment, but nevertheless, it's a well-run company. But the Renters' Rights Act is due to come into operation this summer. We think could be indeed to the rental industry actually, because not least, I won't go into detail, but not least because the functioning of it depends on tribunals, judicial tribunals, and my expectation is that the backlog in those tribunals will be very long indeed, because there are 37 of them and 4.3 million rentals. So there's are specific reasons as well why we cut back.
Thank you very much. I think next one is for Chris. So CGT has increased its dollar exposure significantly over the past 2 months. Are you concerned about Trump's clear determination to interfere with the Fed?
Yes, but to give a slightly longer answer, what I should say is that our move into the dollar in November, December was more a function of our concerns over sterling. We've spent quite a lot of time trying to find alternative currencies that we think are attractive. We're continuing to do work on that, and so it's entirely possible that we will then, we've achieved our initial goal, which was to reduce our exposure to sterling. We may then seek to diversify into other currencies, but we've not finished our work on that yet.
Thank you very much. As always, we have had a couple of questions in gold. So firstly, have we underestimated it being a safe haven? And secondly, with the economy in 2025, we said that we would have gone for Swiss francs or gold. Why didn't we?
Sorry, I said that that's had we had perfect foresight for the geopolitical events that were going to unfold over the course of 2025, then a logical response would have been to do those things. Unfortunately, we're not blessed with perfect foresight. Yes, I think we have been surprised by the extraordinary performance of gold over the last year. Of course, we've been surprised. What we would say is that there has been a huge amount of retail buying, and you can observe that through the growth of ETFs. Historically, this time may be different. Historically, when the ETF volumes or the tonnage of ETF rises very rapidly, that tends to be a contraindicator in the sense that retail buying of gold on speculative grounds rather than for jewelry purposes has historically been in the late stages of gold's strong runs.
Thank you very much. I had a couple of questions on renewable investment trusts. So we've said before that we are avoiding these kind of trusts due to long-term energy price uncertainty. May there be a point where share price reflects that uncertainty?
Right. Well, the thing to say about renewables is that because they are investment trusts, because they're structured as investment trusts, they are forced to produce NAVs. What has become very clear is that the relationship between what they call an NAV, so that's a valuation derived at by modeling by valuers, and what the actual value in the market is, has been really quite marked. So Aquila, chairman actually came out, European renewables, the chairman actually came out in his statement distinguishing between the value, as he called it, and the price that could be achieved for selling the assets. So in our book, there is no difference. An asset value is what you can sell things for. The fact you think they're being sold very cheaply is neither here nor there. And a lot of assets have been for sale, and the sales rate has been very poor. So the answer to your question is, of course, the valuations have improved a lot because the prices have fallen a lot. And they may even be reasonable value here. But we have very little confidence that there are significant buyers for these assets which are for sale. And number one. And number two, that if the valuation is reasonable, and clearly getting more reasonable, then it's exclusively attractive to people who don't pay tax. So if you've got an ISA or SIP, that's fine. But we do not enjoy any investments where the value of the capital falls.
Thank you very much. The next question is, if you think that the TIPS market is underpricing long-term inflation at 2%, why do you conclude in the next slide that you should own them as they look decent relative to stocks? Seems from your own slides, both are expensive in absolute terms.
So I think that, if you forgive me, I think the questioner slightly misunderstands how TIPS work. So obviously, essentially, you earn a real yield, which, as we've indicated, is around 2% if you own a longish duration TIP at the moment. And then on top of that, you earn the inflation rate. And so obviously, to the extent that inflation is higher than the markets are expecting, then you will do better by owning TIPS than you would do by owning, say, nominal treasuries. And so TIPS look very good value when the break-even rate, which is the market's implied forecast for inflation, it's a little bit more complex than that, but that's a good kind of starting point. You do well by owning TIPS when the break-even is low, and the break-even is low today.
Thank you very much. The next question is, with your high-level focus on asset allocation, what is your justification for holding so many investment trust holdings, many below 1%?
Right. Well, perhaps I'll take that. So capital gearing's record has been built on owning investment trusts, and we have made extraordinary excess returns over time in that area. And we continue to believe that there are excess returns available. So that's the reason why we have investment trusts. But the reason why they're relatively small is often that in each holding is often that some of these opportunities are quite illiquid. So we don't want to own too much of any illiquid asset. And secondly, as Chris pointed out before with our Far Eastern holdings, that we don't know which trusts are going to outperform at the asset value level. And diversification is really important. So investment trusts come in and out of fashion, and investment styles come in and out of fashion, and performance varies over time.
Thank you. The next question is, what do you see as the closest historical analogy to the current mix of high asset prices and elevated geopolitical uncertainty?
It's definitely one for you, Peter.
Right. Well, I mean, the high asset value valuations is very easy. So that's 29, it's 2000, it's 2007. I think that the geopolitical stuff is interesting, because the irony is that geopolitics does not seem to affect markets unless it affects economics. So in the 70s, we had a dramatic period of geopolitical influence because the oil price went up enormously. And that influenced inflation and a lot of other things. So today, I'd say that the chief influence of geopolitics is the undermining of NATO on markets. This is because the requirement for defence expenditure is much higher than it has been. We can see the present government struggling with their acknowledgement of the necessity for much higher military spending, defence spending, and a very difficult financial situation. So they barely started to add to the defence expenditure, still at 2.5%. They believe that 3.5% is the correct level, but frankly, most of the journey to getting to that 3.5 is planned to be after the present government has run its course. So, so the geopolitics are very concerning as individuals. I mean, but I think for markets, one has to be very careful not to overreact to geopolitical developments that don't impact economics.
Thank you. In the interest of time, I'll move on to our final question of the day. And if we haven't got back to you, we'll send written responses following the webinar. From an equity perspective, you have shown that the US market appears overvalued, while that valuations within the US market itself and in other geographical areas range from fair to attractive. Why not pursue these opportunities? Clearly, if the US market were to correct, the assumption is that other markets would follow. However, is this assumption still valid today? Could this time be different?
So the first thing to say is that I'm not sure I 100% agree with the statement that there are kind of pockets of really good value in the US. If there are, they're not terribly obvious to us, let's put it that way. So just to give you a couple of examples, obviously there's lots of focus on the tech companies and the valuations there. It's also true that they are enjoying extraordinary earnings growth. Perhaps the valuations are justified. Curiously, it's outside of those that part of the market that, in my view, the American market looks most expensive. So, I mean, this is admittedly a slightly extreme example, but it's not atypical. Walmart trades on over 40 times earnings. Walmart has grown its free cash flow below the rate of inflation over the last decade. So the free cash flow yield on Walmart is lower than that of the free cash flow yield on a 20-year US TIPS at the moment. So it's really not obvious to us that there are large pockets of value. The second thing to say is that we have carried out analysis of every equity market correction over the last 100 years. And what you can see time and time again is that if the US market cracks, everything else goes with it, and the correlation is more or less perfect. So there's really nowhere else to hide. So for as long as we judge American equity markets to be expensive, our overall exposure to risk assets will be constrained.
Thank you very much, and that will conclude today's Q&A session. But if we haven't got back to you, we will send a written follow-up afterwards.
Fantastic. Thank you indeed for covering off those questions you had from investors. As Katie said, the company will be able to review all those questions, submitted and publish responses where appropriate to do so. Before redirecting investors to provide you with their feedback, which I know is particularly important to you and the team, Katie, if I could just ask you for a few closing comments, please.
Yes, certainly. So thank you all so much for attending today's webinar. We really appreciate it. If you have any further questions, please reach out to me directly at ir@cgasset.com or to any of the team here as well. If you have any questions on the funds in particular as well, we are always happy to assist. We hope you enjoyed today's webinar and we wish you a prosperous 2026 year ahead. Thank you very much.
Fantastic. Thank you all for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of CG Asset Management, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.